The dangers of tightening. Why most of the smart money is in money market funds. The Fed's reverse repo explained. Would you rather have $2.1 billion in gold or $2.1 billion in Bitcoin? You can only pick one and you have to hold it for 30 years. I will tell you my answer at the end and explain why. In this video, I will explain why Burry is going to come back and say why he was actually right for saying sell. What's the danger of bank tightening lending standard? Why most of the smart money is in money market funds. The Fed's reverse repo explained right after this. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button, the like button, if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? And here is my book, Rainbow Focus, such an amazing affirmations book. And my client collaboration book, It's Already Yours, Adversity Equals Success, such an amazing book with such incredible authors. Order your copy today. The S&P 500 rally is blinding investors to the dangers of tightening lending standards. It's a major economic warning signal. Depositors are withdrawing money at an unprecedented rate since the 1970s. Low liquidity ratios plus massive deposit outflows equals banks tightening lending standards rapidly. Tight lending standards have consistently led to recessions since 1967. Bank loans have been dropping since Q3 2022, reflecting tighter lending standards. The three-step macro backdrop leading to recessions and earnings contraction. Number 1, Fed tightens monetary policy. Number 2, bank tighten lending standards. Number 3, loans and leases decline due to tightening. Reverse repo offers interest on firms' cash balances. But some analysts say flows add to bank system stress. Banks are under pressure from depositors' embrace of money market funds, pushing a popular Federal Reserve sponsored financing program into the spotlight. Money market fund assets are increasing at a record clip. Much of that cash is making its way to the Fed's overnight reverse repurchase facility, which borrows from money funds and other firms in exchange for securities such as treasuries, and then returns the money the next day. The program, known on Wall Street as reverse repo, allows financial firms and others to earn interest on large cash balances. But some analysts contend it also is effectively draining funds from the banking system, where it otherwise could be invested or lent out. As of Wednesday, more than $2.2 trillion sat in the Fed's reverse repo facility, paying a 4.8% annualized rate. That is well above the rates on offer at most banks. Some analysts are suggesting the Fed should change the terms of the facility to limit further bank distress. Any policy discussion is potentially complicated by factors including the Fed's effort to raise interest rates to control inflation. And officials have indicated in the past that they prefer to allow market forces to work. Every day, firms are handing us over $2 trillion of liquidity they don't need, said Fed Governor. Bank deposits have fallen $363 billion to $17.3 trillion since the beginning of March. Fed data show assets in money market funds have risen $304 billion to a record of $5.2 trillion. According to investment company Institute data, more than 40% of money market fund assets are invested in the reverse repo facility, which the Fed created 10 years ago to lift interest rates with a banking sector that had been flooded with reserves. Roughly $2 trillion or more has been parked there since mid-2022. Demand exploded in 2021. Use of the Fed facility hasn't changed significantly in the weeks since the early March failures of Silicon Valley Bank. But some analysts said banking sector stresses have made it harder to predict how the central bank's relatively new tools will influence overnight lending markets. What different this time is the money market funds aren't really as good at recycling money back into the banking system. Reverse Repo explained. The Federal Reserve's overnight reverse repurchase facility gives lenders such as money market funds a way to earn interest on excess cash. The Fed sells securities, such as treasuries, to a firm with an agreement to repurchase them later at a higher price. The difference between the original price and the repurchase price roughly equates to interest paid to the firm. The operations help the Fed keep the federal funds rate within its target range. Banks have been unwilling to hold extra reserves or liquid, readily available cash at the Fed because of a decision that regulators made last decade. They chose to count those balances towards banks' calculation of a key regulatory buffer known as the supplementary leverage ratio, he said. The treatment of reserves in the leverage ratio is a reason why some large banks in particular don't want more reserves, to reduce the amount of cash sitting at the Fed each night. Central bankers have a few options. One way would be to cut the rate paid to money funds and to reverse the giant sucking of the overnight reverse repo facility. All the Fed needs to do is lower the interest rate it pays. In June 2021, the Fed raised the overnight reverse repo rate by 0.05 percentage point. With interest rates near zero, money market funds were struggling to cover their operating costs, putting a vital part of the financial system at risk. The rate also serves as a floor on short-term interest rates. With rates well above zero, the Fed has the option to push the overnight reverse repo rate back down to the lower end of the federal funds target rate. That would need to coincide with the Fed's raising the rate it pays on bank reserves. A move that could encourage money funds to lend to banks rather than the Fed. Interest on reserves is currently 4.9%. Other analysts said it would be appropriate for the Fed to reduce the interest rate on the reverse repo facility to provide relief to banks that have been slow to raise deposits rates. The facility has been meeting its core objective of providing highly effective control of overnight interest rates, said Brian Sack, a former senior executive at the New York Fed, who helped design the facility. I don't think the Fed should be trying to force savers into bank deposits by making the alternatives less attractive. I don't see reducing the reverse repo rate as an appropriate policy step. Greater competition among banks would tend to raise borrowing cost and hurt profits. That is a dilemma for bankers that was largely absent in the recovery from the 2008 financial crisis. Overwhelmed with deposits following monetary stimulus, many banks have chosen not to pay customers higher rates, even when the Fed raised them. Banks are still losing deposits, but it's mostly small potatoes relative to the roughly $17 trillion in total deposits, said Noor Manay, President and Chief Executive of Los Angeles-based lender CTBC Bank USA, and advisory board member of the Federal Reserve Bank of San Francisco. Absent any more bad news or unforeseen market events, the banking system is stable. Fed officials have said they expect reverse repo balances to decline as they drain reserves from the banking system by shrinking their asset holdings. If the bank balances don't decline, central bankers could bump up against their goal that ample reserves remain floating around the banking system, and raise questions over whether to prematurely end the portfolio runoff program. Officials have signaled they would like to avoid that outcome. The process of redistribution from the overnight reverse repo facility to banks won't necessarily be perfectly smooth. I would pick gold because we have more data to analysis to confirm the value will hold. At $2.1 billion, you don't need to grow your capital, just retain it. Capital preservation. Govs could ban Bitcoin if it was a real threat to their currencies, and it could tank to a smaller number overnight. The U.S. Treasury just released a report on DeFi, illicit finance risk. They said that decentralized crypto markets threaten national security. Looks like the government does want to keep its monopoly on money. You are such a good boy for watching my video right till the end. Bye.